On January 31, 2024, at exactly 10:15 p.m., the Reserve Bank of India sent a single regulatory letter. By morning, the country's most downloaded payments app had been disabled. There was no public warning and no second chance. As the exchange opened, the company's stock hit its lower circuit immediately. Trading was halted multiple times as 7,000 crore rupees in market value evaporated in minutes. On the ground, 33 crore active users found themselves unable to add money to their wallets or process standard banking transactions. The sheer scale of the company suggested it was a permanent fixture of the Indian economy. The central bank proved that no entity is too large to be dismantled. The rise was as steep as the fall. In 2010, Vijay Shekhar Sharma launched a platform with a 1 lakh rupee loan from his brother. This chart shows the moment the app became a national necessity. In 2016, following India's demonetization, user adoption spiked by 435% in a single week. The climb continued until 2021, when the company held an 18,300 crore rupee IPO. By then, its user base was larger than the populations of most countries. The actual engine powering this ecosystem was Paytm Payments Bank Limited. It managed the deposits and enabled the UPI transactions for the entire user base. By 2024, the bank had become critical financial infrastructure. Taking it offline meant disrupting the daily commerce of an entire nation. While the public was shocked, the central bank had been documenting violations for years. The Reserve Bank of India first issued formal notices regarding the bank's onboarding processes in 2018. When the regulator banned the bank from adding new customers in 2021, the company developed workarounds to keep growing while the underlying compliance issues remained unaddressed. Internal audits eventually exposed identity verification failures on an industrial scale. Millions of accounts were being created with fake or duplicate information. Investigators found a single identity card was frequently linked to over 1,000 separate, unverified accounts. These pulsing nodes show how untraceable funds could flow through this system, creating a massive opening for money laundering. Management added 100 million new users while ignoring the verification protocols. They prioritized aggressive scale until the regulatory risk became a systemic threat to the economy. Auditors also uncovered a pipeline of customer financial data moving between the Indian bank and foreign-linked entities within the parent company. Under the 2023 Digital Personal Data Protection Act, this flow of information became a national security risk. India's new focus on data sovereignty left no room for foreign data sharing. In high-level meetings, Sharma reportedly argued the bank's massive size made compliance secondary to growth. To the regulator, this was a refusal to follow the law. With 33 crore users, the bank was deeply embedded in India's payment backbone. The RBI concluded that a bank this large, operating without oversight, posed an existential risk to the financial system. Allowing a defiant entity to ignore the rules threatened the credibility of the entire regulatory framework. To maintain control of the system, the RBI had to remove the bank. On January 31st, the regulator stopped sending warnings and issued a final mandate, requiring a total halt on new deposits and credit transactions. All wallet top-ups were suspended by the end of February. The RBI chose a surgical solution to the problem.
They removed the bank's ability to process money, ending the business model in a single stroke. The fallout hit the street economy first. Thousands of small merchants relying on the platform's QR codes found their payment systems disabled overnight. Gridlock formed at highway toll plazas as millions couldn't recharge their tags, requiring emergency government intervention. Competitors like PhonePe and Google Pay absorbed millions of users in 30 days, permanently resetting the hierarchy of digital payments in India. The chaos proved the regulator's core concern. The country became dangerously dependent on a single private platform that ignored rules for 5 years. For the founder, the collapse was total. Sharma resigned as chairman of the bank, and his personal wealth dropped by 15,000 crore rupees in a matter of days. Every fintech CEO in India now operates with an empowered compliance team. Growth is no longer an excuse for avoiding the law. Success in India's digital economy now requires more than a large user base. It requires a relationship with the regulator that can withstand scrutiny. The bank is gone and the market has stabilized. Paytm provided the growth and the RBI provided the lesson.